Good morning to everybody. Welcome to our 2024-26 business plan presentation. Welcome to all of the people here in the room with us and to the ones connected. I'm here today with Enel CEO, Mr. Flavio Cattaneo, and CFO, Mr. Stefano De Angelis. May I ask to have the agenda on the screen, please? Thank you. Here we are with the agenda for today. Our CEO will drive you through the pillars of the plan, while the CFO will go deeper in financials. After the presentation, we will have a live Q&A session, restricted, I'm afraid, to the people here in the room with us. Thank you, and let me now hand over to our CEO.
Thank you, and welcome to everybody. I kick off my presentation with an overview of the macro environment and how much changed in the past 12 months. Interest rates, headline inflation, GDP growth, they were all strongly impacted by monetary policies, creating a high rates and high inflation world, disrupting the one we were living in. These changes called for prompt adjustment to the scenario assumed in our plan, with consequences on capital allocation I will detail later on. New macros moved into the short-term drivers of our business, as you can see on the next slide. Electricity demand is not seen recovering 2022 levels in the near term. Geopolitical turbulences are still fueling commodity prices far from historical levels. The levelized cost of energy of both wind and solar increased by 5 and 10% compared to the minimum level reached a couple of years ago. Short-term uncertainties require a company to be as flexible as possible. We must be aware, though, that medium trend remains supportive, as you can see on the next slide. Clients will shift their consumption towards electricity, supporting a recovery in power demand. Contracting reserve margin show energy system aren't ready to accommodate this change. Indeed, the closure of installed capacity and lack of investment in generation resulting in a structural tightening in Europe, creating pressure on prices and risk to the system sustainability. Renewables are seen by governments and regulators as a remedy plan. More competitive than conventional generation, they can help in reducing electricity costs and support countries in becoming less dependent from coal, gas, and oil. Higher demand, a need for new capacity, and rebalancing energy mix are resulting in visible long-term trends. It's already evident today the acceleration of the distributed capacity, which calls for grid enhancement to accommodate new connection. Storage will be needed to balance demand with supply from more intermittent capacity. As I said before, onshore renewables will remain cheaper than thermal sources, even if not everywhere and with all the technologies. However, the recent increase in cost and volatility in power prices require projects to be covered by adequate and more predictable returns. Short, medium, and long-term trends are reshaping our key business drivers. Investment will be allocated efficiently with our integrated model to enhance result and speed up delivery. Regulated businesses will be at the core of our strategy, as we see the need to improve quality and resilience and to accommodate for hosting capacity. Of course, this must come together with regulatory frameworks that support value creation. Renewable investment will be cherry-picked, diversifying technologies and countries, analyzing returns and risk, and concentrated capital where the first are maximized, while the latter minimized. We'll leverage on third parties to accelerate paybacks, increase internal rate returns, and valorize our pipeline. Our portfolio of customers as well as end-to-end processes will be optimized to gain efficiency in the acquisition and management of clients and to push actively towards an electrification of consumption. Generation and retail will be managed together with a flexible approach on sourcing, aiming at improving profitability. Our business positioning will be driven by three strategic pillars. The first, capital allocation. Our capital allocation will be extremely selective and flexible, driven by value, focused on opportunities that might arise to maximize the risk-return profile of the group. Second, operations. Group operations will run on simplified processes, a linear organization with a clear accountability. We'll maintain a strict operating cost discipline to improve cash generation and offset rising inflation and cost of capital. And the last pillar, sustainability, will create a sustainable business model able to self-finance its needs and to continue addressing climate change issues. Let's now dive into capital allocation, the first pillar. We define the level of investment required to fulfill our strategic priorities and grow our financials. Rules for investing are simple and clear. First of all, we'll deploy capital where returns are visible, regulatory frameworks remunerative, and macroeconomics and political environments stable. Investment outside core countries where we can't leverage on our integrated position will be very limited. We're going to look for market opportunity if these unlock better value, avoiding market volatility. We'll manage actively our customer portfolio with a multi-play bundled offer. Core countries remain 6, but the strategy associated will be different as each market has its own peculiarities. Stefano will elaborate on that in more detail later on. In the next slide, I show how this mindset translates into numbers. Our investment model will be much capital lighter than before and therefore less risky. This will be achieved due to a higher concentration of capex in networks, unlocking the access to the European grants, and a recourse to third parties in future renewable projects as support of capacity growth. As a result, our investment will translate into a lower need of cash than previously. And not only, the reshuffle of investment will translate into higher returns and more predictability. Compared to the past, we'll invest more in grids, selectively in renewable, and in country where we manage an integrated position and where we see political stability. We focus mostly in Europe. Our capex in networks will be allocated where regulation is protective against macro volatility and returns are well above our cost of capital. Viability of renewable projects depend on market and technology, as an internal rate return associated are maximized where they are hedged by our customers. Now we move to the 3 slides where I detail the drivers in each of our business lines. Investment network will be concentrated on new connection and on improving quality and resilience of the asset base. We'll invest in Europe where we receive proofs that regulatory schemes allow for a fair remuneration on CapEx. As an example, yesterday, the chairman of the Italian authority defined remuneration from grids crucial. We therefore think the extra return for certain strategic projects may be approved, and before investing, will wait concrete action in this sense. Importantly, EU institutions are financially supportive to grids digitalization to make them fit to better accommodate the rapid increase in renewable power generation and allow the offering of efficiency-based solutions such as demand response service and bidirectional power flows. Now let's have a look of renewables. Renewable will be rebalanced in favor of onshore wind and battery storage. To support returns, we'll seek for a continuous optimization of unitary CapEx and OpEx, leveraging also on innovation. In particular, we'll focus on repowering to increase plants' efficiency and reducing generation cost, battery storage to complement the development of renewable capacity while guaranteeing the safety of energy system. Lastly, partnership will be a lever to minimize investment risk while providing the opportunity to improve profitability, shifting towards a capital-lighter model. On the next slide, I detail our strategy on customers. Our focus will be on Italy and Spain, where free markets allow to complement our offers with product or service and with higher marginality. The key drivers of our commercial strategy will be advanced customer segmentation, also with the support of artificial intelligence, to limit the churn and promote customized offering. Channels remix to improve efficiency in clients acquisition and management. Dedicated key account for top B2B and B2G clients. New operating models covering commodity and services with a single touch point. Improve customer experience through simplified and digital process for caring, invoicing, and retention. As a result of our commercial strategy, we expect an improvement of the profitability associated with our rationalized portfolio. Now we walk you through cash generation and efficiency, and we are, in this case, in the second pillar of our strategic plan. The guiding star of our strategic action will be financial equilibrium. The last few years, we have been characterized our action by a cash burn, resulting in an increased level of the group net debt. Our focus is on reverting completely this trend. The next 3 years will see the group generating cash as a net investment, and dividend will be covered by funds from operations. Operating cash flow will be enhanced by a strict cost containment, as shown in the next slide. We'll reduce addressable OpEx and CapEx by 15%. We'll work on reshaping corporate processes entirely, streamlining the organization, optimizing the mix between insourcing and outsourcing, adopting standard and leveraging on technology improvements, adapting to each country. Outside of the addressable cost-based perimeter, we'll also work on the regulated business, reducing costs by 200 million, mainly focused on overheads. The third pillar, the last, our strategy is financial and environmental sustainability. Cash flow generation, cost discipline, and processes streamlining will result in a more solid credit standing. The main metrics will show a sharp improvement of Enel's investment grade profile. Optimization of our asset portfolio, more unregulated activities, will represent a lever to de-risk and support predictability of cash generated. Financial sustainability is to go hand in hand with environmental sustainability. Enel will continue to reduce its direct and indirect greenhouse gas emission in line with the Paris Agreement. For the next year, we have a certified emission reduction targets compliant with the 1.5 Celsius degree pathway. We confirm the target to close all our remaining coal plants by 2027. The achievement of such target will, of course, be subject to the authorization of competent authorities. For their reconversion, Enel will evaluate the best available technology based on the needs indicated by the transmission grid operator. We target to achieve net zero by 2040, when 100% of our power generation will come from renewables, and the push toward electrification will allow us to exit the gas retail business. Let's now take a look at the plant's KPIs and targets. Investment in resiliency and the quality of our grids will result in a 4% reduction in SAIDI, lower network losses, and a higher volume of electricity distributed. Renewable capacity under management will increase to 73 gigawatt with emission-free production reaching more than 80%. That means that lighter capital doesn't mean less renewables. As a result of our commercial policy, around 45% of our customer base will be in the free market, allowing for bundle offerings to pick up. On the next slide, you see our financial targets. We target an EBITDA in 2026, implying a compound annual growth rate of around 5% versus 2023 like for like. Group net income will increase annually by 6% versus 2023 baseline level. And last but not least, we take a commitment to achieve a lower level of leverage, targeting a net debt EBITDA ratio consistent with a solid investment grade. And now we focus on our dividend policy. We are adopting a dividend policy simple, clear, and conjugate the interest of our shareholders with the company need to preserve its credit solidity. Throughout 2026, shareholders will receive a fixed minimum dividend of 43 cents. And this is the base, with an upside. Indeed, shareholders will receive a dividend calculated applying up to 70% payout on ordinary net income if the group is able to maintain neutrality of cash flow. To be clear, we have taken into account in our plan an increase of dividend annually, starting for 2024. Okay? 43 remain for 2023. And then starting with the increase of dividend on an yearly basis. And we are taking into account in our plan. This dividend policy implies a total shareholder return for our shareholders between 12 and 16%. Now I leave the floor to the CFO to go deeper in the plan's numbers, and we'll come back later for some closing remarks. Thank you.
Thank you, Flavio. Good morning to everybody. Nice to meet you, the most of you. My presentation, considering that the CEO presentation was probably about figures in detail, I will try to stay, let me say, in a light description of this slide, considering that to be fast and light is not my best attitude when public is speaking, but I will try to do my best. I will start my presentation as Flavio with capital allocation. In our recurring assessment, we, as you may see, we cross in a sort of matrix the countries and businesses. Then, with each area, we drive investment towards fair and predictable regulation, and where the integrated business coverage allows us to maximize the returns. In this framework, Europe today offers the best opportunity, as we can benefit from full integration along the value chain. In Latin America, we will concentrate investments on networks and position for the progressive liberalization of the retail segment. While finally, in North America, we will leverage on partnership business model and portfolio optimization to fund the activities going forward, while we concentrate on improving profitability of the existing assets. The output of this approach is shown in the next slides. I'm on page 28, perfect. Allocation of investment shifted from capacity growth to a risk-balanced EBITDA conversion, backed by a sustainable value creation. In light of this strategic change, now the lion's share of the accumulated CapEx will be invested in Europe, accounting for approximately 75% of the total investment. There is now a perfect match with the EBITDA contribution, as more than 70% is said to be generated in Italy and Spain. This investment will result in a 17% EBITDA growth in 2026 on a like-for-like basis. Looking more closely to the main business lines and how we set the drivers of capital allocation by business, I will start with grids on the next slide. CapEx will be tailored according with regulatory frameworks in each geography. In Italy, for example, where the regulation is evolving towards a fair and responsive model to macroeconomic variables, we are ready to invest more than 12 billion euro of CapEx, resulting also in a RAB growth of 2 billion. In Spain, investment will be mostly in line and set to the required level of development and maintenance of the network. An improvement of the current set of rules will call for an additional capital allocation. Finally, for LATAM, networks regulation runs on a quite fair frameworks, but offer, in our opinion, a relevant value option to be tapped through quality and resiliency programs. Worth to highlight that in Europe, grids can benefit from a significant budget of grants that will yield a 3.5 billion acceleration opportunities for network upgrade. The results in terms of EBITDA is shown on page 30. The baseline is net of €500 million perimeter effect from the disposal of our asset in Latin America and in Romania. Compared with this 7.4 billion, grids EBITDA is expected to grow almost 1 billion over the plan and reach 8.4 billion on the back of a RAB increase of 200 million. Second, 400 million impact from favorable regulatory drivers, for example, the TOTEX implementation and WOC reset in Italy, as well as the relevant CPI adjustments in Latin America. Then we are also leveraging on efficiencies, whose full perimeter will be detailed later, and that account for another 200 million. Lastly, sorry for repeating 200 million, but it's a good number that sounds well. The last 200 million comes from a volume impact that is associated with the increase of 6 terawatt-hours of electricity distributed in LATAM. And now I move on the generation division. As showed before, Enel focused its recent investment plans in expanding Americas, meaning the whole North and South America, renewables capacity. Now we see the opportunity to counterbalance this move as a clear value enhancement. Accordingly, in Europe, investment will top 7.2 billion, significantly higher than in the past, to drive growth in renewable generation that is backed by our consistent customer base. In Latin America, given the lack of free market and a limited liquid spot market, we will follow a flexible approach based on a risk-weighted renewable development and opportunistic PPA sourcing. Finally, the shift from size to profitability in North America will be centered on cash generation, a self-financed renewable capacity expansion, and leveraging also in our partnership business model. And exactly, I will spend some additional time on this different business model that we are presenting today on slide 32. Our industrial capacity, as you can see, will continue to grow, delivering 14 gigawatts of new additional capacity. The new approach will aim to implement will drive us to maximize the capital returns and productivity with the best risk and return balance. And this translates into 3 parallel business models. The ownership traditional business model to be applied mainly on the where we have the best and top-rated returns with a weighted risk to secure these expected and predictable returns. A partnership business model to foster capacity growth, but limiting the impact on net debt while accelerating paybacks and returns. And finally, the stewardship business model that will continue to be applied to peripheral geographies and, differently from the past, is not expected to generate capital gains over the planned period. This is, I think, very important to underline. We do not have a significant, relevant, or meaningful contribution in the EBITDA growth that the CEO showed you before from selling equity stake and accounting this equity stake into the EBITDA, to be very clear. The first 2 models will result into a return of approximately 300 basis points over the cost of capital. And we expect a double-digit returns on the stewardship model segment. Moving to the next slide, I will detail the evolution and the strategy on our pipeline. As of today, our pipeline amounts to 450 gigawatts, out of which approximately 1/3 is in a mature stage. As we sit on 6 gigawatts in execution, capacity still to be addressed is covered 10 times by the portion of mature pipeline, with code in the 24-26 period. This sizable pipeline and healthy coverage of growth ambition allow us to execute major projects with higher returns and full eligibility in terms of risk hedging, monetize the portion of pipeline which is not instrumental to our industrial growth, and capture opportunities outside of our core countries that can further improve our risk-return profile. Moving now to the other half of our integrated business, in page 34, I will talk about customers. Again, we will act geographically according with local market scenarios and Enel specifics. and in detail, starting from Europe, where we will reduce the cost of sourcing, expanding renewables marginality. The share of fixed sales covered by our own emission-free production will increase, while indexed volumes are naturally hedged by the wholesale power prices. In Latin America, we will remain fully hedged through the increased output of the renewable generation, complementing this with PPA in order to match our top-line expected expansion. Finally, in North America, we will maintain our sourcing sales balance position, and our key priority will be the financial sustainability of renewables development and the improvement of returns in the installed base. In the next slide, I will share some additional point on the full integrated market, meaning Italy and Spain. Despite the decreasing scenario on power prices in both countries, marginality is supported by the increasing coverage of sales to our emission-free production that will result into a reduction of sourcing cost, as I said before, a higher share of volume sold to PDC in both countries, increasing our exposure to the segment with the highest marginality and cross-selling potential. Additionally, we see upside from a multi-play bundle offers that will not only support margins, but also strengthen loyalty and reduce churn looking forward. In the following slide, we will take a closer look on how strategy in terms of capital allocation will be converted into returns. The integrated business EBITDA is expected to grow 1.5 billion euro over the plan on the back of the following dynamics. Renewables growth, as said before, is the result of higher volumes mainly associated with the 13 gigawatt new capacity to be added. On the other hand, this will more than offset conventional generation whose reduced contribution is due to declining volumes also related to the coal capacity phase-out, mainly in Italy, and the normalization of the commodities price environment that drives down the marginality of the thermal generation business. Customers' EBITDA is expected to remain broadly flat over the plan as the higher share of sales covered by our own production and the increasing contribution of our bundle offer strategy will offset the declining power price scenario. Looking at our effort in terms of efficiency, they represent a support to this positive evolution in terms of profitability. The efficiency will total 1.2 billion, and we will build over a reduction of approximately 15% of the addressable cost baseline of 2022, plus the reduction of around 200 million of non-regulated network overheads. The cost reduction effort is visible across all business lines, recording a double-digit improvement of all the KPIs over the planned period. This will free up resources that can be reinvested at double-digit returns and activate a support to the long-term profitability of integrated margin. Effort on costs are mirrored in group streamlining. The leverage of the group was reliant on the execution of an emergency M&A plan worth more than 12 billion for this year. That plan has been reassessed and adjusted based on the eligibility of deals and partially re-engineered to shift gradually into a value-driven portfolio rotation. Also, thanks to this approach, we sold assets at multiples above expectation, overcoming the addressable M&A perimeter by 1.3 times in terms of proceeds. In addition, we originated above 2 billion of new deals in the second half of this year, bringing the 2023 delivery close to the initial target of around 12 billion. In next slide, I will recap the the assets subject to M&A. This morning, we announced the signing of the Peruvian generation asset disposal, progressing swiftly on the plan. On the net debt, this deal has a carryover into 2024, bringing the total expected cash-in related to 2023 into 2024 at around 8 billion euro. This shift is just a consequence of different timing and not a gap in execution, and it is related to mandatory procedures for approval and a necessary remix of projects, with some of them just started in the second part of this year. Let's now move on the financial plan. I'm on page 42. Around 3/4 of our debt is or has been swapped into fixed debt, while on currency, 85% is in euro, leaving residual debt in local currency being naturally hedged by locally generated cash flows. The share of sustainable finance sources on total gross debt will reach around 70% of the total. On the refinancing and cost of gross debt, out of the total 28 billion that will expire over the next 3 years, about 6 billion will be repaid or matched with the disposal to be cashed in 2024, reducing the risk of funding in this period of distressed credit markets, while the remaining portion will be almost entirely covered by our centralized finance at an average cost that we expect to stay in around 4%. This centralized refinancing and the lower exposure to non-core geographies will allow us to reduce the cost of gross debt by approximately 20 basis points, despite the rising interest rates environment. In next page, I will give some highlight in our strong available liquidity that in September amounted to 23 billion, including cash and long-term committed credit line. This allows us to cover 1.3 times long-term debt maturing in the next 24 months, eliminating any financial risk. The level of yearly refinancing on average gross debt during the planned period is now 10%, 8 percentage points below the last 3 years. Let's now dive into net income evolution. As I said before, along the plan, EBITDA is expected to mark a high double-digit growth by around 3 billion cumulated. Financial charges are expected to decline thanks to the lower cost of debt driven by an optimized funding strategy. Tax rate is expected to stay in the range of 29–30% on average. And finally, the trajectory on minorities is primarily driven by the increased earnings contribution from Iberia and Latin America, Brazil, to be more in detail. Finally, on the financial targets, we confirmed the ordinary target we announced at the 9-month result conference call. In addition, we share with you a 2023 baseline into 2024 and pro forma on net debt, which might be useful to define a clean starting point. We also had our guidance for 2024, which, as you can see, underpins a front-loaded growth ambition. And now, finally, I hand over to Flavio.
Thank you.
Veloce, more or less.
Well, I can finish my presentation without having a look at the future. Enel continues to innovate and to monitor less mature technologies that might shape our future. Some example: self-healing network technology to foster digitalization and network integration, long-duration energy storage, green hydrogen if subsidized, new nuclear such as fourth generation and small modular reactors. And lastly, new concept and energy technologies related to space economic trends, like photovoltaic energy production system in orbit and the wireless transmission to the ground. Today, here with me, there are the directors of Enel, fully committed to execute and shared guidelines.